Welcome back to the Capital Mindset Show. Today, we're going back to the subscriber request series. And today we're going to be looking at Mesa Airlines, ticker symbol MESA. Okay. Again, this is a subscriber request, and this is a little known regional airline operator. Okay. So first, as always, we're going to discuss the recent movement in the share price, or at least, when I say recent, maybe 1 year ago. So over the past 1 year, we saw that it peaked out around March of 2021. Yep, March 10th exactly. And it's down about 70% since then. Okay, so there's probably been some major changes or major catalysts that have caused the rise up. And if we look back 5 years, yep, there was a massive rise up from 2020. So we saw the collapse because of the pandemic. So see, that was March 2020. And then they had a massive rise up and then subsequently have come down. Okay, so this is interesting time period for historical context, because now it is in the history books. This was the massive exuberance level that we saw with the SPACs, Wall Street bets. So I'm not saying that this is entirely connected, but this is a very small company, small enough that it may be a target of some sorts to some capacity as far as targeted investment. Okay, that's just, a speculation. That's not really probably what happened. So this has been public since about 2018, and actually has been not so good of an investment. One thing, as we've been stating on this channel for quite some time now, airline businesses is a very difficult business. It's one of the hardest businesses to have long-term success. Sometimes scale can be your friend and your enemy. Okay, what do I mean by that? Well, the larger you are, the harder you fall, quite literally, in the airline space, because if you are larger, you typically might have more leverage. And actually, we'll discuss Mesa's leverage, which is actually not that bad. But for airlines, they typically all have a lot of leverage. And for example, if you take a look at something like American Airlines, what we've discussed on this channel before, American Airlines is probably perhaps the riskiest and is one of the largest operators. Okay, so, and I would probably go as far as to say as it might be riskier than this company here today. Okay, now let's go ahead and discuss some key strategic points that this company kind of told me what they focus on. So this company focuses on trying to become a better work environment. Okay, and I'll go over their business model and explain how they make money in just a second, because it coincides with this. But they target to prospective employees with a good culture, good compensation package, very competitive compensation package above what they probably would make elsewhere. And so what they do, or how they make money, is they are the contracted operator for a lot of these flights, right? And so what that means is you have the consumer facing entity, which is United Airlines or other services, and then they collect the money on their end, and then they contract out Mesa Airlines to then actually supply the crew, do the maintenance costs and stuff like that. So that actually lowers the operational risk for the other airlines, because they're basically passing the buck off to Mesa Airlines, and the Mesa Airlines, that's how they can profit. So already right there, that's a concern for me, because they're not a consumer facing business. However, there's money to be made everywhere. Okay, so that's just because they're not consumer facing, they don't have control over the consumer, does not mean that they can't make money and they can't succeed. Okay, so I think from there, let's actually go ahead and jump over to the model, and then we can kind of figure out, looking at the key ratios, what kind of business we're looking at. So let's share screen. And before we do that, I think we have to ignore this. This is not the right stuff. Okay, let's plug that in. Okay, let's remove that. All right, let's go over the key ratios, and we'll be right back to that. Okay, guys. So first, we're looking at the liquidity ratios, and liquidity ratios don't look too good. When we look at the current ratio, they don't have enough current assets to cover their current liabilities. The cash ratios not looking any better. Now, as far as the total debt ratio and the long-term debt ratio, we do see that they are improving on the long-term debt side. The total debt side, they also are improving, but I'm looking more at the long-term debt there. Debt to equity, it is getting lower. It's actually almost cut in half, so that's nice to see. Gross profit margins, they're actually rising. Well, sorry, not rising. They're declining substantially. So that's concerning. And then that's the pandemic headwinds that I've been seeing. So something that the company's been trying to tell shareholders is that, hey, the pandemic's here and it's messing with our operations. Okay, so that's actually evident in the gross profit margins there. The operating margins, similar story. Well, actually, operating margins are all over the place, because they're up since 2017, but down since 2019. And the net profit margin, pretty it's down, okay, over the longer term. And then no surprise, ROA and ROE are also down. Okay, so not looking too good, but sometimes we want to invest in times when the company is, putting out bad numbers. All right. Okay, so here's where things are interesting, actually. So again, I haven't seen this beforehand because I like to do things with you guys, right, in real time. So looking at the earnings quality, it actually is scoring really well. Okay, that's really surprising. Scoring really well. Again, I always say this to you guys: correlation does not prove causation. This measure that I do, it correlates to performance, but it does not, it's not the cause of it, right? So we can see a high correlation, but that doesn't mean every time it's going to be the case. Like, for example, the Altman Z-score has a 97% confidence. That means 3% of the time it's not. So, and I don't even know what this measure would be. Okay, I haven't really back tested that, but anyways, we're looking at the earnings per share. Earnings per share is declining, and then free cash flows is going up. Okay, so that's quite interesting, because then that means that there's some gap effects going on in there that's actually lowering the net income, but the cash flows are actually rising. They're probably expensing a lot of equipment, if I had to guess. All right, we can actually go investigate that together. And then I'm not really going to look at the activity ratios. Actually, I'll look for the cash. Oh, cash ratio is pretty good. Okay. And this stuff I don't really care about too much for this. All right, so actually let's go ahead and explore. And let me actually zoom in for you guys. Well, actually, I'm going to zoom out because, again, for everyone who watches this video, it looks zoomed out for you guys. It looks normal to me because of the difference in the resolution when I film in my actual screen. And then when I find what I want to show you guys, I'll zoom in for you guys. Don't worry. So taking a look at the income statement, this is where we'll see the gap measures for net income. We can just go down the list here and we can stop here. So operating income is negative already. So this is not ideal, but let's see what's causing that. So total operating expenses. Operating expenses are what's actually the bulk of these. And then what's different from these previous years isn't really much. Okay, what's causing probably a massive increase is this one right here, depreciation amortization, but it's not that much. So that's concerning to me. And if that was the main cause, I wouldn't be as concerned. But if we take this out, if we take out depreciation and amortization, they are positive in a cash flow basis. But we have to realize that these are actual expenses, because eventually those planes need to be replaced, right? And then that's usually we can reflect in CapEx. So that when we let me, again, I forgot to zoom in for you guys. There you go. I promised something. I forgot to do it. But going back here, this is the line item. So depreciation, amortization, we see that. And if we look down here at the operating income, if we subtract that out, we get some well, that's actually EBITDA. But yeah, we'll get out the cash flows, right? And then if we take a look down here, net income, yeah, it's going to be positive because they probably have some credits. Yeah, they have some credits going in here. So that I wouldn't rely on those credits too much to remain cash, sorry, not cash, GAAP net income positive. If their operating income is negative, that's a negative sign. Okay, that's a bad sign, pun intended, negative sign. All right, so let's take a look here at the crux of the model, and we're going to discount it at the classic 10%. So basically how cheap this business is, if you think it's not going to grow whatsoever, it's going to basically remain steady. It's going to get quote unquote an average rate of return or average market rate of return. Let's actually make sure we take a look at the buybacks. So the buybacks, they've been diluting us. That's already a negative sign. So if we see, for example, if they do like negative 10%, even with a negative 10%, that's how cheap it is. Okay, so with a 10% dilution rate, if the cash flows just remain the same, you can expect about a 10%. Now, okay, you see that's a concern to me. So the model is picking up two risks here. So this is why it's so cheap. Okay, down here the model is telling me Altman Z-score of 0.41. That already implies potential bankruptcy. Then the model's also on its own with its own measures. It's taking out, yes, potential bankruptcy. So there's two indicators that are telling me there's a lot of risk involved. And already, we looked at the current ratios. The current ratio is not too good. They are diluting you like crazy. They're probably bleeding cash. Their estimated WACC, the model's picking up, is about 34.03%. Like if they were to use both credit and equity at these prices. They've been managing it quite well, and that's fine. And they've actually been, the dilution accretion is actually really positive, which is, good, I guess. But Not I guess it is good, but you know, there are some very big concerns here, and that's why it's trading so cheap. So you want to be careful, because sometimes when something is so cheap, you know, it probably is for a reason. You know, Howard Marks, many people don't really like to quote him. They always quote Warren Buffett, but Howard Marks is a good guy to quote too. So he always said that if something looks too good to be true, it probably is. Okay. So maybe this is too good to be true. Okay. So there's a lot of ifs in this assumptions. So if for something like this, I would definitely need a huge discount rate. And even with the discount rate, this is actually how cheap it is. This is incredible. Okay. I was not expecting this. I am discounting this thing at 20%, implying a negative 10%. Well, it's a 10% dilution rate every year for 10 years. And we're still in the buy range. Wow. Okay. So that shows me that this is really priced for just the end of the world. Yeah, this is a very cheap stock. So the subscriber who requested this, you have probably picked perhaps the cheapest stock I have seen in the market this year in 2022. If I find one that's cheaper than this, that would be that's incredible. Okay. If I find something cheaper than this. All right. So even discounting at 20, because I'm implying no growth. Okay, guys, I'm implying zero growth. All these empty cells, these are zero. Okay. And I'm just trying to see how much we can push this thing, but I'm basically at the end, we can apply a 25% return rate even with a 10% dilution rate. So that's how incredibly cheap this is. I want to showcase you what this changes if we just say this is zero. If we say this is zero, look at what we could probably discount this thing to. 35, 40. Okay, this is very concerning to me, by the way. This is not the market's either completely stupid on this stock or there's something terribly wrong. And this is a high risk company. All right, we can almost discount this thing at 80%. Okay, let's actually go with a 70. I don't like to do that. 70%. Okay, 68%. I was going to do 69, but I thought you guys would not appreciate that joke. All right, 65% if they don't dilute. Look at that implied return rate. Okay, that would be incredible. There is something fundamentally wrong with this company. The model is telling me that there's heavy chance of bankruptcy. So already on that note, I have to probably follow that word. This is a spec play. I mean, this is something that I would really put in as a speculative play at these prices, and then just with the full expectation that I lose everything. Okay. It's a gamble. Okay. Because I'm gambling on management actually fixing these problems, these rooted problems. And then the market realizing, hey, these problems are fixed. You know, they're going to make tons of money. Okay. So yeah, I see the analysts have a 76.8% upside price on this company. So I don't know. You know, this is one of those. All I'll say for me personally, because I'm not your financial advisor, so I would never recommend this or say not to invest in. That would be your decision. But I can only tell you what I would do. And for me personally, I would definitely be very, very, very cautious about this business. Okay. Yeah, that's all I can say about that. All right, guys. I hope you guys enjoyed this one. Again, if you guys have any requests, go ahead and leave them down below. The system's going to be changing how I take requests, but all the requests that are in there, I'm going to fulfill them, but I'm going to have to change how I take requests because it's just too many. I'll kind of make an announcement soon this month of how that system is going to change, but I really want to continue doing more and more and more requests. And I'll keep trying to get those out to you guys. All right, guys, on that note, I hope you guys have a great one. I'll see you guys on the next one. If you like content like this, go ahead and feel free to leave a like, subscribe if you're not, and you want to see more like this. And then I'll see you guys on the next video. Bye.